and a very pleasant Monday for you. Greg Sher, one-on-one. And this one's going to be a dandy. Vishal Garg, founder and CEO of Better.com, joins me from New York City. What's going on, my friend?
Thank you so much for having me. I'm super pumped to be here. We've had some great conversations and love the idea of doing this.
Yeah, me too. I'm really excited to talk to you. I found it very fascinating doing some background on you. You already know all this stuff, but the audience likely doesn't. I didn't. You moved to Queens in, let's see, you were 7 years old, I believe. You resold books, Cliff Notes, study guides, and thrift store clothes at a profit. So you learned how to be an entrepreneur at a pretty young age.
Oh, we were hustling in the 718, my friend. You know,
I love it.
To get out of 718 to 212.
Yeah, I get it. Oh, believe me, I understand. Then you studied finance and international business at the Stern School of Business in New York University, while working as a runner and entry clerk at Solomon Brothers, and as a trader for a hedge fund. When did you start to love numbers? When did you start to get that zest and that love for them?
I think I came to this country and, you know, the teachers were amazing and they really helped encourage that. And then I went to this high school in downtown Manhattan called Stuyvesant High School, where there were a lot of kids that were really good at math and science. And the school like encouraged that, you know, rather than sort of like downplaying it. And so we could really thrive in that kind of environment. And then what was awesome was like, I always thought I was going to be like a researcher or a scientist, but then I started working on Wall Street as a way to make some extra money. So I didn't have to like burden my parents with like paying for my extracurriculars or just hanging out. And that was when my love of numbers met with like things you could change. So you could use numbers to change outcomes and you could actually make money doing that. And so when I realized that, that's sort of how I dived into finance.
Yeah. And you got into mortgage after a frustrating experience of your own. What happened?
Well, it's really funny because after the credit crisis, I was spending time building up portfolios and buying portfolios of student loans, buying portfolios of mortgages, RMBS securities, and CDOs. And we created a way to figure out how to like value every house in every RMBS deal, figure out what amount of payment people could afford. And then I went to go get my own mortgage, and the big bank that I applied for a mortgage for, where my wife was actually working, they said it would take them like 3 weeks to get me a pre-approval letter and that like they'd be able to close in 8. And I was like, wow, you know, I can like value every house in every RMBS securitization in America instantly. I can figure out the borrower's capacity to pay and what likely the loan is worth. And here, this big bank where my wife actually works is going to take 2 months to make a mortgage. And ultimately, we ended up losing the house that we were going to buy. And I actually took the down payment that I was going to use and used it to buy Better.com, the domain name, to make the mortgage process better.
I'm assuming you bought that from a broker that was taken at the time.
Yeah, no, it was a guy in Germany that registered it like on the early days of the internet. And like I stalked him and I found out who he was, and then I made him a deal that he couldn't refuse.
Oh yeah, well that's how it works in this world. So
right.
Being an outsider to mortgage, but knowing numbers really well, what has that been like? Like it's one thing to know numbers and to see an opportunity, but without the pedigree, the mortgage pedigree, you know, having been a loan officer, for instance, as many CEOs are. What kind of challenges did that present, or has it presented for you that you feel like are unique that maybe you didn't know when you dipped your toe in the water?
Well, it's interesting. So, you know, the first mortgage company that I decided to buy a mortgage company rather than start one from scratch to get the license and get the history and like have basically all the machine working so I could see the entire assembly line. And the first thing I did was, you know, I did the job of a loan officer. I was a loan officer assistant. Then I did processing. I did underwriting. I basically did this all for a couple of weeks. And I basically realized that there are all these things where basically the consumer experience required a lot more automation. And I was like, there are all these people. Like, this was an old school mortgage company. They were literally going and getting the consumer's info on a yellow sticky pad and then passing it on to a guy who would basically like pull the consumer's credit, send it to the printer, and then staple it to the file. And then another guy who would like do the income verification, another guy who would call the employer, another guy who would like, get an AVM. And like they kept stapling it to the file. And I was like, these people shouldn't be doing this. The computer should talk to the next computer and basically go and get all of this information. And I think, honestly, for the most part, that turned out to be true, right? There's a lot of manual work that can be automated with the computer talking to the computer. But then there's the hand-holding part of it, which is the beginning of it, which I think, quite frankly, it is America's largest financial asset. It is in average families, 85% of their net worth is in their home and in their home equity, and people need consultation. And, knowing math, I also know like when they stopped teaching math in public schools in America, right? Like, you basically don't really learn new math if you don't want to past 8th grade. And so when in your regular life do you have to multiply a 6-digit number by a 3-digit fractional, like percentage amount, right? And divide that by 360. Right. And like you don't do that. And so people need others to help explain the difference between the choices that they have. And there's a lot of choices in mortgage land. And I think that was, what some of the realization has been over this period of time is Americans are not financially secure in general. They're not like, accustomed to shopping around for financial products. Even the CFPB says like 82% of mortgage borrowers never shop around. They have one credit pull their entire time. And they're afraid of getting rejected. Like, because the mortgage is kind of like the report card, your financial report card for what you've been up to since you graduated from college. And a lot of people make a lot of mistakes between the time they graduate from college and the time they're ready to buy a house. And people are unable to interpret this report card. And so they're scared of getting approved. And so those are some of the things that we've tried to make easier along the way now that we understand the mortgage business a little bit better.
Yeah, so let's jump into your mortgage business. Better is up 100% over the past year. Your line of credit facility, and that business is up 160% year over year. I know you're pleased with your trajectory, and that's in a tough market too. And it looks like things are about to change. So what's been the key to your success in the face of some pretty significant headwinds?
Well, an investor who is been in financial services for a long time, particularly in mortgage, who invested in our company in our Series A, he basically said, in mortgage, survival is winning. And so when the downturn comes, just being able to survive and thrive and just keep pushing the pace of innovation and keep rolling out new products, keep trying new things. Like, I would say 22 was really tough. 23 was really tough. 24 was tough. And then this year we finally have figured out how to make fire again. And, that was very different than 2016 to 2021. 2016, we did 500 million of volume. 2021, we did 58 billion of volume. We grew over 100x in the space of 5 years. The tech platform.
Stop right there. Did you say 58 billion with a B?
Yes.
58 billion.
58 billion.
That's incredible.
And then we had to shrink 90% plus. And now we're back to rebuilding and growing again around 3 major pivots that we made. The first was moving from a non-commissioned sales model to a commissioned sales model. And instead of viewing the traditional loan officer as someone to disintermediate, as to disrupt, to viewing them as a partner in the process, and really then creating a set of tools that allowed them to do their life's best work, to make them more productive, to help them make more money, to help them treat their customers better, to help them lower costs and financing costs for their customers. So I think that was the first big pivot. The second was launching a home equity product, which is now about half our business. And, it's 2 years later and we're, about 2/3 the size of Figure in D2C. We're growing 5 times faster than they are. And we have a clear line of sight to being the largest home equity, non-bank home equity provider in the country in the next 3 years. And then the third was honestly leaning into the AI, like really early, not like last year, but like 2.5 years ago. We've always built what we called a supervised learning network, which is a AI platform built on rules and calculations, and effectively a machine learning driven matching engine on top of that. That made us so powerful when we leaned into Gen AI. And with the launch of Gen AI, and our partnership with OpenAI, we have now been able to do extraordinary things and really lead the industry in pushing what AI can do. And I think all those three things finally work together, even in a shitty market environment in the past 12 months, to help us more than double our business.
Yeah, we're going to go back to COVID here shortly, because those were really challenging times for all of us. We were all scrambling, trying to make heads and tails and make the right decisions for our companies. But before we do that, just want to highlight some names that people probably know that are pretty prominent in your organization right now. You brought in Neo, led by Ryan Grant. He certainly has a stellar reputation, great guy. And then Chad Smith is the COO. He ran Direct Lending, Loan Depot, Caliber, then founded Mission Loan. So, you put some key pieces in place that I'm sure you want to take a second to brag about.
Oh, totally. I think we had the tech, we didn't have the mortgage. And honestly, that worked for us for refi. But when the environment changed and we wanted to lean into purchase, fundamentally, that lack of senior mortgage expertise, like A-plus players from the mortgage industry being part of our team, when we did that and Chad leaned in and came on board as the president and COO, and then he brought in the team from Neo, and Ryan and Danny and Chris joined, we are learning so much from them, right? We're like, oh, wow. Like, this is like, when you take tech people, they're like, this is like my waterfall. This is why the consumer is like where the breakage is. This is where they're not clicking. And then it's like, well, they're not clicking because you're saying this, and they think of it as that. And you're like, oh shit, I didn't know. And then there are all these, oh shit, I didn't know things that start to like get smaller and smaller and smaller. And then it starts to be, and that's like part one. And then part two is, here's what you should be doing. And then your product roadmap changes. And then that gets better and better. And ultimately, the numbers speak for themselves. We've improved our conversion rate by about 40%. And that's a huge, huge impact, considering the fact that top of funnel, we pre-approve about 360,000 consumers a year, right? Credit, income, DTI pre-approvals. And that's like 6% of American home shoppers every year. So like we have this massive top of the funnel that we're just not monetizing. We were like basically monetizing like leaving 95% of them to go elsewhere. And now we've been able to start and fix that.
Yeah, and you're doing a lot of that through Betsy, who I've spoken to multiple times. Betsy is the agentic AI that does a lot of intake on the front end. And I've had some incredible conversations with Betsy. Can you do this? Can you do that? If I'm part-time or I'm just getting out of school, can my income qualify? I mean, Betsy can go far and can go deep. And I know you're in the very beginning stages of Betsy. As Betsy relates to the humans and to loan officers, and obviously you're leaning heavier and heavier into machine learning and AI. Where do you think the loan officer ultimately lands in this process? Let's look 36 months ahead. I'm not talking about the better process. Let's just talk about the process of mortgage, if your vision is spot on.
Yeah, I think the best analogy is what has happened to the stockbroker, right? So the stockbroker was focused in an era of 2% commissions in and out, was focused on stock trades, on transactions, right? They'd recommend stock trades to you. You'd put on the stock trade and you'd make that happen. We don't really have stockbrokers anymore. It's taken 30, 40 years, but we don't have stockbrokers anymore. We have financial advisors. They holistically look at all of your assets. They come up with like plans to help you save for college, save for buying a home, save for retirement, major life moments. They might help you get a bunch of different products, but you're a financial advisor. I think the loan officer has this unique point of view for helping Americans with two of their biggest asset and their biggest source of liabilities. So on the asset side, you have the ability to help them become the home advisor, right? Like, what should they be doing with their home? How should they be optimizing it? How should they optimize paying for it? What should they be doing about it? And on the liability side, the average American has more debt than ever before. They have debt like across the board. If you look at a credit bureau for an average American, they have a personal installment loan, they have a credit card, they have a buy now, pay later loan, they may have an auto loan, they've got a mortgage. And fundamentally, nobody's sitting there, particularly on the debt side, and helping them optimize their debts. There's like no debt advisor for them. And what we can do is empower the loan officer to think beyond the singular transaction to, hey, what is the object of desire the consumer wants? They want a home, like they want a better home. They want to upgrade from a rental to owning, or they want to own a larger home, one like, with room for their mother-in-law, one for their kids, whatever. So that they can do that. And then on the debt side, nobody in banking or finance is helping a consumer today optimize all of their debts to like match what their income is, match their capacity to pay, optimize the interest rate across all of those things. And the home equity plus mortgage products combined together can really help like provide consumers the lowest cost of financing for everything that they need in their life. And I think that's what, a loan officer becomes over time.
Yeah. You talked about debt. Let's talk about what it's like to have investors. You've got some very well committed investors. I know that you've raised well over $1 billion, probably closer to $2 billion since your inception. You went public via a SPAC. What kind of added opportunity and pressure does that present for you as the person at the helm?
I think the big difference between the investor base that we have and the investor base a traditional mortgage company would have is that they really believe in the future we laid out. And the future we laid out was a future built around making home ownership and home finance better for everyone. And I think they were shooting from the moon, like when they started. So like our first Series A was led by Goldman Sachs. Our Series B was led by Kleiner Perkins. Like these are like, two opposite ends of the spectrum. Kleiner Perkins is like the investor that invested in Amazon and Google. And, Goldman Sachs is like the preeminent investment bank. But like they were both looking for a vision of, can you build a platform that takes the mortgage process, makes it transparent, makes it cheaper, makes it faster, makes it easier? And can that be the dominant underlying mortgage platform used by everyone in the mortgage industry, from mortgage investors to mortgage brokers to mortgage loan officers to consumers? And that's what we really set out to build. And we are still at very early in the journey because these platform businesses take 20, 30 years to manifest themselves over time.
Well, let me just stop you right there. I mean, are you behind though where you thought you would be? In other words, when you sat down at the table and you presented your the portfolio and the opportunity for the investors, the timeline, right? You couldn't have envisioned COVID would happen, right? You couldn't envision the snapback to 8% rates would happen. So are you where you thought you'd be at this point?
I thought we would be farther ahead in our D2C business. I think the rates going up by 450 basis points really put a damper on that. And I think that like we couldn't have predicted COVID, we couldn't have predicted 3 trillion of stimulus, and then we couldn't have predicted like, mid-single digit like inflation, which then led to, 8% rates. So I think that we're behind where we wanted to be in the D2C business. We are ahead of where we want to be in the mortgage industry and mortgage professionals starting to adopt our platform. And I think we are ahead of where we wanted to be in terms of AI making an impact on the cost of production of a mortgage. And I think we're like significantly farther ahead and have line of sight into something where in a pure rules-based machine learning environment, it was going to take a lot longer, right? Investors were going to have to adapt. Now with Gen AI, investors don't have to adapt. And so we're farther ahead from a technical standpoint.
Yeah,
and
what's
that's
interesting,
why we're able to continue to raise money.
yeah,
Like,
I think the moment too is interesting because how has the psyche of your investors changed now that we're starting to see light at the end of the tunnel? I know there's a lot of money coming in the private equity VC space into mortgages, and especially companies that have AI, and certainly you've got some of the best AI out there. Have you seen a change? And right now you've got kindling, like you've got those little pieces of wood that are about to head into the fire. We know what happens when you're trying to get a fire going and you take those little sticks of wood and you put them in there under the big logs. It does feel like we're at this inflection point where all the data is suggesting we're about to turn the corner. So what kind of ingredients and motivation does that give the whole team? That's you, that's your leaders, that's the investors, everybody.
I think our investors are really psyched about the combination of AI plus like our push into retail. And, the idea that we don't have to convince every consumer in America. We can convince the people that already convince the consumers in America, right? So the retail loan officer, the retail mortgage broker, those people already have convinced that, a large swath of purchase mortgage consumers, 1.2 trillion last year, right? A volume went through those pipes that is a superior way to go. And so we don't have to convince, millions of consumers. We can convince the people that convince those folks, and by providing them a superior platform by which to do their business, we can grow exponentially like we used to from 2016 to 2021. So I think that has been the biggest feedback loop that we have gotten, is turning our business from a pure direct-to-consumer business to a B2B2C business and empowering other mortgage professionals to build on top of the Tin Man platform. That's been the biggest thing for us in allowing us to continue to grow and have line of sight to profitability and to continue to be very attractive to investors. And I think that's very analogous, we tell people, to sort of what happened with Amazon from 1995 to 2001. It was a direct-to-consumer business. Then they took the awesome fulfillment, customer base, and delivery mechanisms and started to empower local merchants to use the Amazon platform. And now 65% plus of transactions on Amazon are done by third-party sellers. And it's actually the best part of their business. And then eventually they took that same platform that they built on the computing side and built it into AWS. And so the third-party seller marketplace in AWS are way worth more than the D2C business. And I think that's the same thing that's starting to manifest here at Better. People start to see that, and they start to see the new retail loan officers that are coming and joining our platform. In our last earnings call, we talked about a bunch of them, right? We've taken the existing Neo business and grown that pretty dramatically in the past, just like quarter alone. And we see the line of sight into growing that further. So I think that's super exciting for investors.
Vishal, who's your biggest competition? Like who's the biggest threat out there when you look at platforms that you respect and feel are, heading down a similar path? Obviously, you've got your own special sauce, but when you look at the big picture, is it Rocket? Who is it?
I think our competitor has yet to be defined. I think our competitor, considering the range of channels that we're operating in, I think it would be easy to say it's Rocket, right? I think that would be the easiest thing to say, is that it's Rocket. But I do think that it's basically the incumbent mortgage industry and the platforms that have come to place in the incumbent mortgage industry that are overcharging their consumers, right? So if it's like direct to consumer, it's the guys that are charging consumers 400 basis points, right, to book a D2C mortgage off a servicing book. If you think about it's retail, It's the folks that are, out there, like effectively their customer is the loan officer, right? They're like taking a bigger slice of the pie, right? Than, what necessarily those loan officers can get from alternative models, right? If it's, mortgage brokers, it's like who is taking a bigger chunk of the transaction from fulfillment, underwriting, capital markets. And I think that each part of the mortgage food chain is burdened by these legacy companies with their legacy costs. And I do think that's our competition.
So the biggest threat, the biggest threat is the threat that has not emerged yet. Is the answer to my question. But you do at the same time see what others are doing that kind of hang in a similar place. You're watching all the moves. You see Lakeview acquire Guild. They've got that tremendous servicing book. You see Rocket roll up Redfin, which is a lead machine, and then Mr. Cooper with that robust servicing. How do you look at that? Could there be a move in the not too distant future? I mean, is Better looking at opportunities, or would Better consider opportunities that could bring leads into the funnel, partnerships like that?
We would definitely consider that, but honestly, like, we have plenty of leads. We need people who can service those customers, right? And service those customers in the way that they expect to be serviced. And so I think that's sort of what we're looking at. And I think it's very important to like think of these things like high level, right? But just because you have an MSR book and you buy a retail loan originator doesn't mean that the people in your MSR book are going to, choose to transact with the retail loan officer that they're matched to. If you buy a realtor that's a discount realtor, and you go take those discount realtor customers, like the kind of customer that wants to sign up to sell their house for 2% instead of 3%, like, sell side commission, that's like a value seeking customer. That customer isn't going to be the guy that's going to sign up for a 400 basis point gain on sale D2C experience. So I think people are doing things, but I'm not necessarily sure if like that's aligned with like the thing that we've always thought about is like, is the customer base getting enough value out of the product and getting the value that they expect? And, only then will they stick. Consumers have the ability to go anywhere they want, right?
Yeah.
Like it's sort of like people say, okay, I'm going to buy an MSR pool instead of spending money on CAC. Well, you have a refi wave, your MSR is like go to zero, right? Suddenly it gets refinanced out, like, and you can't keep up. So you bought like all this MSR, but then you don't have the, loan officers, processors, underwriters to go finance that, like go process that. And these waves are going to be shorter and shorter and tighter and tighter. And you've underinvested in AI to do that. How are you going to actually like monetize the MSRs when they come? It's like people are not like, I think there's a lot of people in the mortgage industry that sort of see what is happening in these other industries that are getting disrupted by AI and are like trying to find marriages, but they may be marriages of convenience rather than marriages that make strategic sense.
Yeah. At the same time, I can be sitting down watching TV, and at any moment I can see a Better.com commercial come on. So you're obviously, and they're phenomenal commercials. Whoever's doing all of that is really, really excellent. But you're clearly pouring money into the idea of advertising. I mean, it's pretty old school, really, to buy media. Are you convinced that that's going to continue to work for years to come, and that's kind of why I asked through the lens of, because you could potentially acquire something where you don't have to spend to bring those leads in, and so I'm wondering how strong you think the legs are underneath that strategy for driving in leads.
I think we shared it in our last earnings call, but the factory makes money now, so we're making enough money that like we're earning about a 15% net contribution margin on our business, and that number has doubled from Q2 to Q1, from Q1 to Q2 of this year, and we see it continuing to grow higher. And so as long as that number is positive, it makes sense for us to spend money to continue to grow our presence with the consumer. And I do think that we are in a mode where we're investing. As you know, I mean, I've been out there on LinkedIn, like one of the more successful programs that we have put together is taking consumers who come to us in our direct to consumer channel and then matching them with the retail loan officers that are best equipped to serve them based on that consumer's characteristics. And that has been amazing because like those consumers are converting at 2x the rate, being matched to that local loan officer rather than, us traditionally fighting to keep that customer from the local loan officer. And so I think there's just so much that we're doing here that can optimize that further. And if we are able to get this D2C to drop, to transfer the consumer to the local retail loan officer who's on our platform working, then you'll see our ad spend go up by 5x, 10x from here.
Yeah, and plus it was kind of a trick question because we know that you've been spending that money at 8%, 7.5%, 7%. Now at below 7%. When that thing goes down to below 6%, you're going to continue to deliver higher returns. And let's be honest, only a handful of lenders out there have the powder to even put it into that vertical. So I do think you have an edge when it comes to that. Tell me, Vishal, what keeps you up at night when it comes to the business?
I think inflation staying high keeps me up at night. Because as you know, we keep investing in our business. I do think that we've got a really good legislative environment over the next 2 to 3 years. But we don't know what comes after that. So really speed keeps me up at night. Like us competing against the latest startup from Silicon Valley, right? Where like they have like the culture now in Silicon Valley in these AI startups, it's 996, 9 a.m. to 9 p.m., 6 days a week in the office. Like we've got to keep up with that. Like that keeps me up at night. I think those are the types of things that, like the disruption never comes from the places that you expect. It comes from the person that comes up with something that you didn't expect. Yeah.
What's the plan with Tinman? That's your platform. I saw that you are now licensing it out to a bank. I mean, is this part of your revenue strategy? Could IMBs or brokers eventually have access to this? What is the plan, and what kind of revenue driver do you expect that to be?
I think Tinman is going to be bigger than Better.com D2C. I think Tinman has the potential to be our version of AWS for the mortgage industry.
Why? What about it? What about it? Because a lot of people, 99.9% of the people that hear us talk about this Tinman, they don't even know what it is.
So Tinman is a point of sale system, LOS, CRM, pricing engine, eligibility engine, compliance engine, document engine, all in one flow, all in one piece of software. You turn it on. You don't pay any implementation fee. You don't pay any per seat fee. You don't pay any per application fee. The entire platform comes on a per funded loan basis, which is super disruptive from the rest of the industry, right? And their cost models. And we are licensing it out to brokers, IMBs, banks, and others. And we believe there is an ability to take Tinman and make it the de facto platform for the industry. Right now, a lot of that is focused on home equity products. And, the bank, though, is using it for home equity, conforming mortgage, and non-QM. And so, Tinman covers all of the different product types. And we're continuing to build on it. And we do believe it is the platform of the future on which and how mortgages will be decisioned. We've done over 100 billion of volume on Tinman. It's our own, we've dog fooded it. The loans produced on it have, 1/30th the critical defect rate that the rest of the industry typically experiences, and outperform on delinquency rates by a factor of 5 to 1. And so we think there's just this amazing platform that we built for ourselves that everyone in the mortgage industry should use.
Vishal, let's go back to COVID for a minute before we wrap up. I mean, obviously there was a period of time where, we all had to make tough decisions, right? And we all had to figure out what path we were going to go down. And unfortunately, every company that made promises about retaining and keeping their people were faced with unthinkable, unimaginable circumstances. And it's pretty well known that you had a situation where you laid off a bunch of people on a Zoom. And, I know I've talked to you offline about this. I know you learned an awful lot about that, from that experience, and you grew from it. Can you talk a little bit about that? I hope I'm not taking you down an uncomfortable path, but there'll be some people that watch this that want to know kind of what you learned from that, how you grew, and if you had to do it all over again, what would you have changed? I just want to give you the opportunity to speak to it.
Yeah. So Greg, I think it's a great question. I totally fumbled that. I didn't do a good job of being, an empathetic leader to the people that were letting go. And, there obviously were major decisions that I had to make at that time, but I could wish I had done it differently. To give you some context, rates started going up. Like, we started losing money in the third and fourth quarter of 21. We had put on a lot of people to continue to grow on the anticipation that rates were going to come down. I restructured our deal with SoftBank. I brought in $750 million of capital over Thanksgiving. And I even personally guaranteed that capital that came in. And then from there, part of the goal was, with all of our investors on the board, is that we have to lower our expenses. And so I went out, we looked at the folks that weren't performing as well as the average person, and we made a list. And, my head of sales and operations, who was a great people leader, she said, I'm not going to do this. My head of HR, she quit. And so, I went out and did it. And I'm a product and tech and capital markets person. And I should have done a much better job at it. But ultimately, that downsizing, plus the fact that we were early in downsizing and reacting pretty rapidly, means that we are able to survive today. We wouldn't be here today if we kept on losing money at the rate that we were losing in December of 2021. So ultimately, what did we do? We helped continue to serve American consumers. We created the path for the company to make a comeback. And I could have done that better. But, here we are today. I think, our path and our future is really, really bright. And a lot of that has to do with the tough decisions that we took, in the fourth quarter of 2021.
What was that period like for you, though? I can just put myself in your shoes and go, oh my goodness, I should have handled that differently. Once the genie's kind of out of the bottle, and we've all had these moments in our lives where we do something that we live to regret, right? And we can't take it back, but we're tortured by the fact that what was I thinking? I should have done it like this, but I did it like that. And then for me personally, I wrestle with moments like that, and it will stay on my mind, Vishal, for months, maybe even years. It's hard to let go of that. So I'm wondering what that was like, and how you managed to get to the other side mentally to emerge a better leader.
I think, listen, it's crazy. People were doing death threats to my family, to my wife and kids, sending nasty emails and, calling them up. And it was just crazy. It was a moment. And I had to question, am I in this? Was this a trade for me? Should I just leave? Should I take a package and leave? Should, a lot of tech CEOs would have done. And I was like, no, you know what? Actually, making the company that makes home finance better, that's my life's work. That's what I'm here for. And this is going to take a while, and we're going to recover from this, and we're going to build back from this. But this is why I'm here. So I'm not a tourist.
Yeah.
There are lots of people that have kind of come and gone in the mortgage business. People come in and try to disrupt. I'm not a tourist. I'm here. I'm going to be here 10 years from now. I'm going to be here 20 years from now. And we're going to keep on making the process better for consumers. And I think, the thing that kept me going is, every consumer that gets pre-approved it better gets an email from me. And I had customers who wrote to me during that time telling me, because of you, and you intervened on my mortgage process, and you responded to this email that I sent, about something that wasn't going right. That's how I have my home. That's how my family, got this asset that's now appreciated and valued, that we enjoy. And I was like, as long as the consumers keep coming, as long as the customers keep coming, we have to keep serving them. And ultimately, that's like it's the same as if I owned a pizza store in Queens. Like as long as they keep coming and asking for pizza, I'm going to keep, making it.
Yeah.
And so, that's sort of what got me through that path at that time. And now we're on the other side of it.
Yeah, you are. And, I commend you for that, and for also, allowing me to go there. Because when we have these moments, sometimes it's good to talk about it, right? And I don't see you on a ton of these verticals, having conversations. So I appreciate your trust in me and giving people, the window into those moments, and to also the moment we're in right now, where you are grabbing more market share, where your investors are excited, where you've got the leaders that you need to grow, where Betsy's just crushing it, where your AI is underwriting something like 40%, and going to be 75% by year end. So I've really enjoyed this time with you. Anything else you want to add here at the end?
Oh, thank you so much. And listen, I think there's a lot that we have to learn. We can learn a lot from you. We can learn a lot from all of our retail partners. We're just at the very early innings of what we can do together and what we can build together and make it better for consumers and for the average American family. And ultimately, I think everyone in the mortgage industry, it's just a tough business with the cycles and everything else. But ultimately, like, we put people in houses. There's lots of ways to make money on Wall Street. There's lots of ways to make money in America. But, I think we do something that is noble and positive and makes a difference for people's lives. And I think ultimately, even in the worst of times, when we were doing we went down as low as like 500 loans one month, right? And even that month, fine, we still put 25 people in a home every day. And that's meaningful. So, I think that's even in the worst of times, you can look into that. And so I appreciate everyone in the mortgage industry for doing what they do.
Well, Vishal Garg, founder and CEO of Better.com, looking forward to continuing the path that you're traveling down. And thank you for giving us a little glimpse into it here on One-on-One.
Thank you for having me, Greg. It's been awesome.
Have a great, yeah, same here. We'll do this again soon. Have a great Monday, everybody. We'll see you next Monday on One-on-One.